Welcome to today's Explainer. We're going to dive right in and do a mechanical teardown of a financial engine that silently runs some of the biggest businesses in the world. We're looking right under the hood of SAP S/4HANA's payment engine, specifically zooming in on how it configures payment terms and cash discounts. So, if you've ever found yourself wondering how massive enterprises manage to automate literally millions of complex invoice payments without dropping the ball, well, you are in the right place.
It all really starts with this simple but profound question. How does a system automatically know exactly when to pay an invoice? Think about it for a second. We're talking thousands of vendors, entirely different negotiated terms, varying tax laws, and early payment discounts. It's not magic, right? It's a highly structured set of rules that trigger this massive automated process in the background. And today, we're going to decode those exact rules.
Okay, let's look at the structural blueprint of the engine we are deconstructing today. First up, the mechanics of payment terms. Second, deriving the baseline date. Third, where do terms actually originate? Fourth, installments and special cases. And fifth, gross versus net procedures.
Let's get right into Section 1, the mechanics of payment terms. These are the foundational gears of the entire payment system. Basically, terms of payment are the conditions you agree upon with your business partners. They define the due date and any cash discount offered for payment within a specific time frame. But here's the thing, these aren't just polite suggestions on an invoice. In S/4HANA, they are the absolute strict parameters that dictate two crucial things: when exactly the money is due and how much discount you get for paying early. They're the fundamental rules that wake the system up and tell it what to do. To actually calculate the due date and the discount, the SAP engine requires three specific interlocking pieces of data. First, it needs the baseline date. Second, the cash discount terms, meaning the valid time frame for a discount. And third, the cash discount percentage rate itself. Once you feed those into the system, S/4HANA essentially takes the wheel and automates the rest. But to really get how this works, we need to take a much closer look at Step 1.
Which brings us to Section 2, deriving the baseline date. This is arguably the most critical component.
Now, what's really interesting about the baseline date is that it acts as your absolute anchor. Every subsequent calculation, when the invoice is ultimately due or how much of a discount you've earned, is derived directly from this single point in time. It's essentially the starting gun for the payment race.
So how does the system figure out this anchor date? Well, S/4HANA gives you some incredibly flexible options here. It can use default values proposed right by the system, like the posting date, the document date, or the entry date. But you can also configure the engine to overwrite those calendar days by setting a fixed day. For example, making the baseline date always fall on the 15th of the month, totally regardless of when the invoice actually arrived. You can even configure it to add a set number of additional months. It's all about giving businesses total granular control over their payment timelines.
Let's move on to Section 3, where do terms originate? Now that we know how the system calculates the date, we need to know where it's pulling these rules from.
These terms live inside the master record of a customer or vendor, which SAP calls the business partner. And it's pretty brilliant, because the origin point of the invoice dictates exactly which segment and role the system uses to grab those default terms. If the invoice originates in financials, it pulls from the company code segment using the FI role. If it starts in sales order management, it defaults to the sales area segment and the SD role. Purchasing management, it grabs from the purchasing organization segment using the role. The engine is smart enough to recognize your business context and automatically pull the exact right terms.
And that context becomes a real game changer when we start talking about credit memos. If you've got an invoice-related credit memo, you just link it to the original invoice. The system neatly copies the payment terms right over, meaning both the invoice and the memo are due on the exact same date. Smooth, right? But if you have what they call other credit memos, standalone ones not linked to an invoice, the system ignores standard payment terms and makes them due immediately on the baseline date. To actually activate payment terms for those standalone memos, you have to manually enter a V in the reference field. It's a very precise manual trigger overriding a highly automated system.
Section 4, Installments and Special Cases. This is where we look at the more nuanced gears handling complex scenarios.
We all know that sometimes an invoice just isn't paid all at once. It gets split up into an installment plan. When you define installment payments, S/4HANA automatically splits the total amount into partial amounts, giving each one a separate line item and due date. But here is the absolute golden rule: 100%. When you configure the percentage rates for those individual installments, they have to total exactly 100.
If they total 99.9, the engine simply refuses to run the calculation. It's a strict mechanical rule.
Another really clever special case is the concept of day limits. Date limits let you define date-specific terms of payment inside a single terms of payment key. Imagine you have a rule where invoices dated up to the 15th are payable by the end of the next month, but invoices arriving after the 15th get a whole extra month. Instead of creating a messy web of separate rules, SAP lets you use just one single key that holds two separate logic paths based on that day limit. It keeps the system incredibly clean.
Now, beyond just dates and discounts, these payment terms also configure essential security controls. You can assign a block key, which literally blocks line items from being paid during posting. It means the payment program cannot touch that item until a second person goes in, checks the invoice, and manually removes the block, perfectly enforcing the dual control principle. On top of that, the terms can also dictate the physical payment method, whether it's going to be a check, a bank transfer, or a bill of exchange.
All right, bringing it home with Section 5, Gross versus Net Procedures. This is where we dive into the deep accounting logic of how the discount money is actually routed.
Depending on the legal framework of the country you're operating in, the base value used to calculate your cash discount actually changes. This beautifully illustrates the logic at play. In the gross procedure, used in places like Germany or Switzerland, the cash discount base includes the tax on sales and purchases. But in the net procedure, the cash discount base is calculated strictly on the net value, meaning it strips the tax out first. You just configure your company code's global parameters, and the system handles the rest.
Let's actually track how the net procedure mechanically routes that money step by step. When you post a vendor invoice using the net procedure, the system anticipates the discount right out of the gate. Step 1. It immediately reduces the cash discount amount from your expense account. Step 2. It parks that exact amount in a cash discount clearing account to balance the books. Step 3. When you actually pay the invoice, it clears that posting. But here is the kicker. Step 4. If you miss the deadline and pay late, the system automatically posts the cash discount you lost to a separate discount loss account. So the engine is constantly self-reconciling, tracking the money you spent, the money you saved, and exactly what you failed to save.
So we've essentially popped the hood today and seen exactly how SAP S/4HANA translates messy business negotiations into strict, automated system logic. From anchoring the baseline date to enforcing security controls all the way to tracking lost discounts. It's an incredibly powerful engine. But I want to leave you with this provocative thought. If a finely tuned engine automates your cash flow down to the exact day and the exact percentage, what happens to your business when these foundational rules are misconfigured? Understanding these mechanics is absolutely crucial. It's not just about learning software. It's about maintaining total control over your organization's financial lifeblood. Thank you so much for joining me for this explainer today, and I hope you're ready to go master the configurations in your own systems.